How a central banker's low-rate shift showed the way for Fed. Richmond, Virginia, AP, in mid-2016, even with unemployment falling and the economy growing modestly, James Bullard, head of the St. Louis Federal Reserve Bank, was concerned. Months earlier, with Bullard's support, the Fed had raised rates for the first time in 7 years. Panicky financial markets responded by sending stocks tumbling. The Fed delayed plans for further rate hikes. Through it all, there was still no sign of higher inflation, the supposed bogeyman that had led the Fed to raise rates in the first place. "We were expecting inflation to pick up," Bullard acknowledged in an interview this month. "We had the idea that we should be preemptive and prevent that from happening. But a lot of those predictions didn't come true. So that made me think that we didn't have the right framework." Bullard decided to develop a new framework, which he announced in June 2016. It was based on a notion that Bullard was among the first Fed officials to fully recognize that the U.S. economy was stuck in a rut, with low growth and low worker productivity, and wouldn't likely spark high inflation even if unemployment kept falling. It's a notion that members of the Fed's rate-setting committee, including Chairman Jerome Powell, have come to collectively embrace. It helps explain why Powell has made clear, as recently as this week, that he sees no need to raise rates anytime soon despite an unemployment rate near a 50-year low. Bullard's framework flew in the face of a long-standing belief among economists that as unemployment falls steadily, employers will keep raising wages and high inflation will follow. Casting aside such traditional economic models, Bullard felt that the economy could keep growing and employers could keep hiring without igniting inflation. He argued that the Fed would probably need to raise rates only once more, to a range of just 0.5% to 0.75%. That view, highly unusual 3 years ago, transformed Bullard from a centrist member of the Fed's policy-making committee to one of the more dovish. Doves typically worry less about inflation and more about sustaining growth and employment. Hawks generally favor higher rates to control inflation. Most Fed policymakers at that time worried that the unemployment rate -5% in December 2015 was low enough that it would likely accelerate wages and inflation. They wanted to lift the Fed's benchmark short-term rate closer to its historical norms after 7 years of holding it at zero. The consensus then was that a rate as high as 3.5% would still be neutral, that is, it would neither support nor restrain growth. And yet since late last year, the Fed has shifted much closer to Bullard's position. Powell has engineered 3 rate cuts since July, to a range of just 1.5% to 1.75%. These cuts followed 4 rate hikes. For more on this story, visit the news article link.